Okay, let's unpack this. We're looking at a stack of sources that make a really bold and specific claim.
That's a big one.
Yeah, that the American financial system is right on the edge of its largest transformation in, decades?
Oh, at least. This isn't just an upgrade. The argument here is that it's a fundamental restructuring of how value moves.
And right in the middle of all that, our sources are pointing to one ecosystem they believe is perfectly positioned to lead: Metallicus.
And that concept of transformation is, it's the key. For years, blockchain was seen as, a toy? Or maybe a speculative sideshow?
Right.
The argument now is that institutions and U.S. policymakers are finally seeing it as core financial infrastructure, something suitable for, regulated banking.
So our mission today is to pull out the key pillars from this material that support that claim. The idea that this ecosystem should be number one in the U.S.
And it's a really interesting case.
It is, because it doesn't rely on, just abstract tech superiority or some decentralized ethos. The entire argument hinges on direct, deliberate alignment with U.S. policy and established financial institutions. It's about building with the system.
It's the compliant playbook. That's what it is. And it starts at the very foundation. I mean, while the sources say these big-name chains fought battles with regulators, Metallicus was quietly building within the rules, not around them.
That is a fascinating contrast. So what does a decade of doing that, of having that compliance culture, what does that actually mean for the tech itself?
It means they adopted a compliance-first culture. It's rooted in their history as a U.S.-based fintech. They didn't just wait for the rules to come to them. They engineered the system to meet existing U.S. financial law from day one. And this goes way beyond just, typical crypto transparency.
So we're talking about core banking requirements here, the kind that every single bank in the country has to follow.
Exactly. We're talking about designing the technology to enforce KYC, Know Your Customer, AML, anti-money laundering, and the BSA, the Bank Secrecy Act. Now, just for context, the BSA is why banks have to file suspicious activity reports.
Okay.
This system is literally built to provide those kinds of reporting capabilities, just seamlessly.
But the sources, they go even further. They point to alignment with the specific laws, like the Genius Act and the Clarity Act. If I'm a listener, I hear those names and I think, okay, what rules are they actually following that maybe their competitors aren't?
And that's where the real policy insight comes in. So the Clarity Act, for example, it often deals with how to classify and regulate things like stablecoins.
Trying to create.
Right, exactly. Trying to create clarity around their legal status.
Okay.
The fact that Metallicus built a framework that was already anticipating that kind of move meant they weren't scrambling when regulators finally started paying attention.
So they were ahead of the curve.
Way ahead. And the crucial insight from the Q2 2025 report is that U.S. policy is now finally catching up to and aligning with this kind of institution-ready compliance stack. It's essentially validating the path they took, which makes them, the preferred long-term partner.
And this whole compliance thing, it isn't just an add-on. It's baked into the architecture, which I think is why we have to talk about this integrated vertical stack.
Yes.
It seems key to understanding that compliance culture, especially this identity and compliance layer.
Right. They didn't just bolt on some KYC checks at the front door. They built a true vertical financial stack. That means every single piece of the process, from the base layer all the way to the consumer wallet, is controlled and compliant.
So if I'm an institution, what does that identity layer give me specifically? What's the benefit?
It gives you traceability. It gives you certainty. It includes DID, decentralized identity. You could think of that as like a compliant digital passport for users.
Oh.
It also includes know your transaction capabilities.
Yeah.
So it's not just about who started the transaction, but tracing every single hop it makes. And all of that is coupled with institutional dashboards and full auditability.
Wow.
And that level of transparency, it's just non-negotiable for a regulated bank.
Yeah.
They can't, by law, operate in the kind of regulatory gray area that, let's be honest, a lot of decentralized networks prefer.
That makes the why really clear. But the real test is always adoption, isn't it? The sources call this the separation point, that they are onboarding American financial institutions, not just chasing crypto traders. So are we seeing real banks, real credit unions actually signing on?
We are. We're seeing hard evidence in this Q2 report of real institutional adoption. And this isn't some sandbox test. We're talking about live pilots inside regulated institutions.
Okay, so what are the numbers? What's the scale we're talking about here?
Right now, there are 12 credit unions actively in their stablecoin pilot program. Now, 12 might not sound like a huge number at first.
What?
But the really important detail is the customization. Each of those credit unions is issuing its own custom-branded one-to-one US dollar-backed stablecoins.
Wait, so they're not just using a generic stablecoin like a USDC or something. They're using the infrastructure to create their own tied directly to their balance sheet.
Precisely. They are testing the system's ability to digitize their own liabilities, and the scale expands from there pretty fast because they're partnering with organizations like GOES-CUA, which represents over 300 institutions.
300?
And DeLand CUSO.
Hold on, we just hit another acronym. What on earth is a CUSO, and why is that the fast track to getting to scale?
A CUSO is a credit union service organization. Think of it like a shared tech provider or a service hub that's owned by the credit unions themselves.
Ah, okay.
So by partnering with one CUSO, you get access to potentially hundreds of credit unions all at once. It enables a really rapid, standardized rollout across that whole network. It immediately scales their reach way beyond those initial 12 pilots.
That's a clever strategy. You go through the existing service providers instead of knocking on every single door.
Much smarter.
But, institutional adoption, it needs specialized tech. Traditional blockchains just weren't built for this. And that's where the tech engine comes in. The A-Chain plus the Pulse virtual machine. The sources call it the most advanced banking virtual machine ever built.
That is a very strong claim, so I have to break that down. The PulseVM, it's engineered specifically for these complex banking workloads. It's not about, processing JPEGs or gaming assets.
Right.
It's about optimizing performance strictly for financial services.
So what does a bank need from a virtual machine that say a normal dApp might not? You mentioned things like strict determinism and contract lifecycle validation. Why are those things mission critical for a regulated bank?
Okay, so let's start with strict determinism. In simple terms, it means if you run the same transaction on the VM 10 times, you get the exact same predictable result every single time.
100% predictable.
100%. For a bank, if a $100,000 transaction fails, they need to know instantly with total certainty why it failed, down to the line of code. For audits, for settlement, that's everything. Most general-purpose chains have a sort of probabilistic finality that banks just cannot tolerate.
That makes perfect sense. They need assurance, not just speed. Okay, so what about contract lifecycle validation?
That all ties into security. Banks can't just deploy a smart contract that hasn't been thoroughly vetted.
Of course not.
Contract lifecycle validation is the feature that ensures code is reviewed, approved, and then locked down by those institutional dashboards before it can ever go live. It prevents rogue code, it prevents unexpected changes, which is a huge regulatory concern when you're deploying large amounts of capital.
It really sounds like this is the first VM that was engineered from the ground up to meet the very stringent and high-performance needs of the U.S. financial system.
That's the analytical takeaway, yep.
Yeah.
It's a high-performance VM, but it's optimized specifically for banking and for stablecoins.
Before we move on, I just have to inject the thought here. If this compliant approach and this specialized tech is so superior for banks, why haven't we heard more about it until recently? Was that quiet strategy maybe slower than the disruptive approach?
That's a great question. For a long time, the flashy disruptive chains, they got all the attention, right? They attracted retail users, venture capital, often by just sidestepping or even fighting regulation.
Right. Move fast and break things.
Exactly. Compliance is slow, it's detailed, it's expensive work. Metallicus spent a decade doing that foundational work, building relationships, vetting code. The payoff for that only happens when the U.S. regulatory environment finally catches up and says, okay, we're ready to adopt, but only if you meet these institutional standards.
And that's the inflection point we're seeing now.
That's it. The quiet strategy is suddenly the preferred one.
That transition brings us perfectly to the infrastructure piece, what the report calls the crown jewels of this whole strategy. Let's talk about FedNow, the ultimate integration point for U.S. finance.
FedNow is the Federal Reserve's instant payment network. Right now, moving money between banks can take days or, at least hours.
Yeah, it's ancient.
It's ancient, but Metallicus is actively integrating with this instant payment rail.
The Q2 report says the FedNow production environment is built with final validation underway. What does that mean for a bank? Why should they care?
When it goes live, it's a profound change. Think about the friction. Traditional payment rails are expensive. They rely on legacy tech. By connecting directly to FedNow, Metallicus can instantly pull compliant fiat currency from a bank and tokenize it into a stablecoin on-chain.
Instantly.
Instantly, or do the reverse. Redeem that stablecoin back into dollars and push it instantly into any FedNow connected account in the country.
So you get two massive benefits: drastically lower cost for settlement and instant finality, which has to be huge for managing liquidity.
Absolutely. The moment it's live, Metallicus claims it becomes the instant settlement bridge between U.S. banks and the regulated blockchain ecosystem. It moves the whole infrastructure from being some adjacent technology to being a core integrated part of how high-value instant money moves across the entire U.S. financial system.
Okay, that is integration with federal infrastructure. Now let's pivot to their role with other crypto networks. The report suggests Metallicus is becoming the banking layer for Ethereum. I mean, that's a massive claim given Ethereum's size.
It is strategic, and the source is connected directly back to that compliance engine we talked about. Ethereum is the largest smart contract network, but getting compliant, instant fiat currency onto Ethereum has always been messy and slow for institutions.
Yeah, it relies on a bunch of different, sometimes less regulated third parties.
Exactly.
But wouldn't established on-ramps like, say, Coinbase or traditional custodians, wouldn't they be immediate competition here? What makes this connection different?
The difference is in the deep integration and the compliant nature of the rail itself. The sources claim Ethereum will actually depend on the Metallicus rails, specifically their Layer 2, Metal L2, for seamless fiat-to-crypto deposits that guarantee bank-grade compliance and instant settlement because of that FedNow connection.
So let me get this straight. If a big financial institution wants to use a DeFi service on Ethereum, they don't have to trust some third-party crypto exchange. They just use the Metallicus system as the trusted, regulated pipe, which then bridges the capital over to Ethereum for them.
Precisely. They're positioning themselves not as a competitor to Ethereum, but as an essential service provider, the compliant, institutional, governed on-ramp for the world's largest smart contract platform. It makes them a critical power source for institutional access.
All of this, this complex architecture, the regulatory alignment, it would mean nothing if they weren't actually executing. The Q2 2025 report really emphasizes their velocity, that they are shipping at a remarkable pace.
Indeed. We've seen a relentless tempo of delivery across the whole vertical stack. It shows they're rapidly industrializing this infrastructure.
Okay, so give us a taste of those accomplishments and maybe define the jargon as we go.
Okay. So beyond the stablecoin pilots and the institutional dashboards we mentioned, we saw the launch of XMD on Metal L2. XMD is their new utility and governance token.
And L2 is layer 2, so it's a scaling solution. Makes things faster and cheaper.
Exactly. They also delivered the MPD liquidity mechanism, that's a new liquidity pool structure, to make sure the stablecoins hold their peg efficiently.
Okay, that's the internal plumbing. What about the big external infrastructure milestones?
Crucially, they built out the FedNow integration environment, which proved the connection is physically ready. They also completed A-Chain contract execution, confirming that their compliant VM is fully functional. And then on the consumer side, they rolled out the WebAuth to MetalPay fiat onboarding process and the MetalPay API.
So they're connecting the regulated core all the way out to the end user.
They are.
And speaking of the end user, let's just briefly review the rest of that integrated stack. We've focused a lot on the compliance and blockchain layers. What's in the financial and consumer layers?
The financial layer is where the actual money moves. So you've got the CU-issued stablecoins, both custodial and non-custodial rails, those really important bank-grade APIs that institutions plug into their own systems, and of course that pending FedNow connection.
Yeah.
It's the core financial engine.
And the consumer layer, that's the public face of the whole ecosystem.
That's the front end, the access point for you, the user. It includes the WebAuth Wallet, which is a self-custody wallet built for safety, MetalPay for general fiat access, MetalX for DeFi, and lending features.
All built on those compliant rails.
Right, and there's specific loan protocol. It's a completely comprehensive ecosystem. Every layer is covered, from the core compliant blockchain all the way up to the apps you'd use on your phone.
So if we summarize the conclusion from all this source material, the U.S. adoption argument, it really boils down to institutional compliance and deep integration. They bet their future on working inside the lines.
They did. The argument is that the U.S. will ultimately adopt the ecosystem that supports U.S. regulations, that integrates with FedNow, that serves banks and credit unions directly, that can bridge compliantly to essential networks like Ethereum, and offers the most complete compliant stack ever created. And the sources state pretty unequivocally that this ecosystem is Metallicus.
This whole deep dive, it really provides a critical lens for watching the institutionalization of blockchain in the U.S. The path to adoption isn't necessarily through, outright disruption. It's through this deep regulated integration.
And that leads to a final provocative thought for you to mull over. Since this entire ecosystem is built to be a compliant banking layer and this highly integrated vertical financial stack, which maximizes control and auditability, the question is, does the future of regulated financial blockchain require this specific level of integration and maybe the necessary centralization that comes with it to achieve mainstream adoption? Or can genuinely decentralized, less integrated networks still win the long game by maintaining a pure crypto ethos, outside of these highly compliant walls?